Well, to break it all down, we are joined now by Lawrence Yoon. He is Senior Vice President of Research at the National Association of Realtors. Lawrence, it's great to have you with us.
Good morning, Tredney.
Now, let's just get into this fresh data. What does the latest inflation data from January 15th tell us about the current state of the housing market?
Well, it is a good news on the inflation front. Now, of course, the headline figure actually rose from the prior month, but the data that I am looking at is the housing shelter inflationary pressure, and it was the lowest in 3 years. It's still notching up at better than 4%, but the private sector data is essentially saying it's not rising, so I think there's more room to calm down, which means that overall inflation will be much calmer later in the year. And I think that will allow the Federal Reserve to make deeper rate cuts as inflation comes down.
With 2.2 million jobs added just last year and strong wage growth, how is the robust labor market influencing housing demand overall?
It's very good that the labor market is still solid because in order to buy a home, one has to have a job. But what we saw is that in the past 2 years, even with job creation, home sales did not rise. And the reasoning for that was mortgage rate keep rising. And the funny development was ever since the Federal Reserve cut interest rate in mid-September, mortgage rates have risen from that time. So we have a gap between mortgage rate along with what the Federal Reserve has been doing. But I think it's just inevitable that the mortgage rate will settle down towards about 6 to 6.5%, say mid-year this year, later. Don't expect 3%, 4%, 5% mortgage rate, but the new normal of 6% stabilizing, job gains, inventory growth, these are positive development for more home sales, which will help contribute to economic growth.
And with consumers actively looking for inventory, how are builders responding to the increased demand, and what's the outlook for the new housing market, as it's kicking off this year?
One can just look at the stock prices of the builders. Lennar, KB Homes, Toll Brothers, it is up substantially from 2-3 years ago. So there is an optimism. There is capital available, and we still have a lingering housing shortage. So the builder just need to get more active. But what we are also finding is that many existing homeowners are also beginning to list their property from life-changing events. Perhaps there is a new job in different part of the town requiring relocation or additional child in the family and people have to trade up, or people are retiring and they want to trade down. So all of these life-changing events constantly occur. So with the passage of time, the lock-in effect becomes less strong, so more inventory coming onto the market.
And you've talked about this before, but is there an oversupply in the apartment sector? And do you think that's likely to affect housing affordability and the broader real estate market?
You pointed out a very important part where we have a temporary oversupply of apartments, or new apartment units still hitting the market even as the vacancy rates are rising. Now, there is still demand for apartment units, but the supply is outpacing demand, and therefore the rents are not rising. And this is a indirect relationship with mortgage rate, because once the rents calm down, that means that Federal Reserve will see overall consumer price inflation to be much better behaved and allowing the Fed to cut interest rate, and the mortgage rate, I believe, will be following that path, unlike what has happened recent months. So as the inflation comes down, mortgage rate will follow the path of the Federal Reserve.
Lawrence, are there specific regions or markets that you're following where you're seeing home sales are jumping or showing significant gains due to improved inventory levels?
We are seeing a great activity, for example, in Charlotte, North Carolina, Knoxville, Tennessee, in the area with job growth, relative affordability, and inventory showing up. The Midwest of the country, Indianapolis, Kansas City, homes are just generally very, very affordable. So someone who has the flexibility to work from anywhere consider the Midwest America. But one point that I'm watching carefully is the devastation was happening in Los Angeles from the fires. Because there was a massive housing shortage to begin with. Now we are removing some housing stock. The rents will be rising quite strongly in the LA surrounding area temporarily. But what we find in the overall long term following a natural disaster is there's always a recovery. So we do anticipate recovery. Right now, there is the difficult housing shortage situation in the LA market.
Now, briefly, Lawrence, I'm interested to get your take on if you think that increased productivity and production in the construction industry can help mitigate rising costs and stabilize mortgage rates.
Oh yes, absolutely. Because one of the barriers to buying a home was the affordability challenges. So to the degree that more homes can be built more cheaply, maybe modular production, more assembly at the factory, and then move it into the land site. All these are positive development, higher productivity, and more access for middle income, moderate income families to purchase a home.
Thank you so much, Lawrence, for all of those key insights. Lawrence Yoon, Chief Economist and SVP of Research at the National Association of Realtors.
Thank you.